Hello and welcome back to another episode of the Startup Lantern. In a recent episode, we talked about stock and how stock gets allocated out among venture capitalists. We hit on the topic of angel investors, but during a conversation with an entrepreneur over the last week, I realized that we didn't provide a lot of clarity around what happens with an angel investor's money. Is it a loan? Is it a stock buy, etc.? So I wanted to jump back into that real quickly today and cover that topic a little bit further to provide some additional clarity. So join us shortly as we jump back into the Startup Lantern. Hi, I'm John Duran, your co-host here on the Startup Lantern.
And I'm Druce McFarlane.
Welcome to another episode. So as I mentioned in the teaser, in a previous episode, we talked about how venture capitalist funding is allocated, how stock is structured, etc. And began to realize in some conversation with entrepreneurs that we might not have provided enough clarity around the aspects associated with angel investors. And that also brought up a conversation, as Druce and I were talking through it, the concept of more of friends and family investments that may happen even before angel investors. So I wanted to jump into that real briefly, have a short episode, and try to provide some additional clarity around those two ideas. So Druce, thanks for coming back on another topic with me here, because I know stock's probably not the most fun topic to talk about, but it is really confusing, and I think it's important that we provide enough clarity that people who are starting companies go in with at least educated on what this means. So I'll tee this up with in a previous episode. One of the things I think was probably also a big misconception for many is the venture capitalist investment that involves stock is not them buying the stock for that money. They're actually loaning you money, and they expect that money to be paid back in the future at some point. And in other episodes, we've talked about, Series A, B, C, D, E, et cetera, in funding. Every time you take more funding, you're just increasing the debt that you have to pay back at some point. When it comes to angel investors, angel investment money in many cases happens before you ever go to a venture capitalist. Usually, you find those locally, you may know some folks, et cetera. When they provide funding into your startup organization, how is that structured as it compares to the venture capitalist, which I would really term very much as a loan?
First of all, whether you're a venture capitalist, whether you're an angel or whatever, the way that it works is whatever both sides agree upon. So, it really comes down to that. Like there is a typical way that a lot of, especially Silicon Valley style investments end up working, and that's what we've been describing here. But really, what it comes down to is it's whatever you and the person on the other side of the table agree to. Now, having said that, the way that I have typically seen this done is really two different ways. So we'll start off with your traditional. We've gone out there, we've solicited funds from some people out there that we know that have deep pockets, et cetera. And we're getting ready to go in, and we know that sort of on the heels of this, we want to go through and we want to get our Series A funding. But we want to, you don't want to go grocery shopping when you're hungry, and you don't want to talk to a VC when you're short on cash. So often you go out there and you go out and you find some angel investors just to put some money in your account so you can make payroll so that you're not hungry when you talk to them. In those circumstances, you're treating the angel very much the exact same way that you would be treating your venture capitalist. Matter of fact, the big difference is when you talk to a venture capitalist, they've got the high-priced, highfalutin lawyers who are going to be able to negotiate everything and put down the term sheet and all the rest of it. And when you talk to an angel, the angel doesn't have those types of resources. So what the angel will often do is they will make their agreement with you, with terms that are transferable to equivalent terms of the Series A. So in other words, whatever the eventual VC ends up negotiating, that's what they get. So if the VC says, okay, we're going to get our shares for $1 a share and we're blah blah blah, then the angel gets the exact same deal, which is interesting because that means when the angel first invests, they're kind of investing a little bit blindly because they don't know what your company is going to be valued at. They just know that they're putting in some money and they have a general idea as to what they think they're going to be getting, because you're going to share with them, like this is what we're going to go out there and ask for. They typically aren't too concerned about that because no matter, like if you're a startup and you're asking them for some money, the chances of you having a lawyer who can run circles around the lawyer of a VC firm are very low. So the VC is going to be able to negotiate far better terms than the angel investors' own attorneys would end up being able to do. So they feel like they're going to be in good hands because the VC's attorneys are going to be able to cover everything. And they end up getting those exact same terms. So they basically, think about it this way. They would love to be able to go in and help fund one of these large VC firms, but they don't have the standing to be able to do one of those types of investments. So this is their way of being able to get the same type of deal that the VC ends up getting with a fraction of the amount of money. So that's how that works. Now, having said that, there's a different type of angel that we can end up getting as well. And that's, like with the cell phone plans, it's the friends and family plan. You started up, you've got your startup, and mom and dad, want to show their support for you. So they want to throw $100,000 into the equation for you to help you start off your company. And in those circumstances, you're probably giving them like, okay, you're giving us this money, we're going to give you this amount of stock. Really it comes down to that first comment that I made, which is you get to do whatever you've agreed to be able to do. But in general, those types of early investments, that's what it comes down to. They're so early that you're giving them some sort of founder stock or whatever in exchange for that cash. It's not something that you typically do with people who aren't friends and family. Like if you're going out there and talking to regular angels, they don't get that kind of a deal. Especially like that makes more sense like when you're first structuring the company, you're first incorporating, and then they can get added on there. And I mentioned earlier in a previous episode, there are different types of corporations, and with the type of they're going to be a little bit reluctant. Like you're going to want to be a little bit reluctant behind giving people some of that early stock. We'll just put it that way. You've got a limited amount. You're going to be coming out with a finite number, maybe like it's 1 million shares or whatever. And if you're selling shares, you have to give away some of that. So if you're giving away some of those are shares that would either have been in your pocket or they're shares that might have been in some talent that you want to attract. And if you're selling your own shares, then that means that you're kind of diluting your own ownership of the company. So it's just problematic. You want to avoid those unless it's like you don't want to disappoint mom and dad. After that circumstance, it really ends up going more that VC direction.
Druce, thanks for coming back. I know this is really not one of the most easy topics we cover, and probably not one of the more exciting topics. But I do think it's critically important to understand exactly how all that works, because if you are starting a company, and our goal here is to help others, take that first step and get out there and start the company they've always dreamed of. The more you know, the more prepared you'll be, and the more capable you are of reaching that success in the business. So if you like what you've heard here, we encourage you to subscribe, like the podcast, join us on a regular basis. We release these on a frequent basis. We've covered a lot of topics to date, still have a lot of topics to go, and looking forward to hearing your comments. So please drop your thoughts, your ideas, your questions. Just like this one came from a conversation with an entrepreneur, we want to hear from you. So if you've got questions that are challenging your business, or maybe that you're preventing you from starting that the company you've wanted, drop those ideas here, and Druce and I will be happy to dig into some of those and maybe make those topics for some of our future shows. And Druce,
and one other thing before we leave, I want to mention is like, in every single episode, we have a tendency of saying we're not lawyers. We are just people who have gone through this a couple of times. And it's episodes just like this that we do that for, because there are so many different ways that this type of thing can actually be structured. And we don't want to say like, this is the way and it's the only way and all the rest of it. This is why you need good legal advice. as you're trying to do these things is they can steer you through how these different things work, and they'll be able to tell you the benefits and the drawbacks behind all of this stuff. So do go out there if you've got a startup, make sure that you've got good legal representation, and they're going to help guide you through some of these principles. There is no right or wrong. There's just what you get both sides to agree to, which is why we make that disclaimer.
Thanks for joining us. We look forward to seeing you on a future episode of the Startup Planner.